Yes, Deutsche Bank senior U.S. economist Brett Ryan with us here at Post 9. Brett, market suggesting otherwise today.
The market has been swinging around back and forth a lot recently. And to be sure, that's definitely up in the air at the moment. And, just as Bostic said, there was a lot of debate going right up into the meeting. Our base case remains that they will get one more hike in at the May meeting, but that obviously depends on financial stability issues and bank turmoil, becoming under control and the Fed regaining control of the narrative.
Well, that's what I was going to say. Are you expecting one more hike because you see inflation still as a big problem and not coming down fast enough, or because you see the bank crisis as not getting worse?
No, I think it's balancing between monetary policy goals, which is guiding inflation back, and also financial stability goals. And in fact, St. Louis Fed President Jim Bullard pointed to our index, financial conditions index, earlier this morning in a speech. And what makes ours different is that we include the Senior Loan Officer Survey, which is a really important measure of banks' tightening of credit standards. Our research, we've said that could cause 50 to 100 basis points drag on GDP growth through the back half of the year. So that's something the Fed's going to take into account when it meets next in May. We're going to get the next edition of the Senior Loan Officer Survey at the beginning of May. That will be an important data point for both ourselves and the Fed.
We have to wait all the way to May to find out how the lending standards are changing. So you say half a percentage point of GDP to 1 percentage point of GDP. How do you know how severe this lending crunch is going to be?
Sure. So basically, we take the Senior Loan Officer Survey and our conditions index, which has a nice history, and we run regressions on what that has tended to lead to in terms of GDP growth in subsequent quarters, because the Senior Loan Officer Survey is a great leading indicator by about 2 quarters on GDP, particularly for CapEx and for businesses. And so that's how we kind of come up with that range. And we do a shock of a mild shock versus a more severe shock. So a mild shock would get you something closer to 50, whereas a more severe one, a percentage point. And that's important because we're already expecting a baseline recession to start in Q4 of this year.
If you do kind of have these scenarios playing out, this kind of like tree of outcomes, if you look at the way things are priced out right now in the marketplace, is there a dislocation in your mind? We're looking at things like spreads for high yield securities, corporate investment grade, certain parts of the market in the stock market with regard to small caps. Bruce Richards brought that up earlier on. Are there things that lend you to believe that base case has a higher probability of happening, or something perhaps softer than that?
Sure. So it's certainly making a fundamental story out of the moves that we're seeing when 2 years flying around 30 basis points is a little bit difficult. But take a step back. We've had the speed of the move over the past 3 weeks was of historic proportions. But we're kind of pricing in the curve similar to where we were at the beginning of the year, when the market was expecting the Fed to be cutting in the back half of the year. So, and the amount of cuts are changing daily, and the Fed's going to have to see where the dust settles. But it does increase our conviction, these latest, banking sector turmoil, that we are heading for recession. And in fact, if you look at the Fed's SEP forecast of 0.4%, if they're anywhere near we are for Q1, which is around 2.5%, and they assume positive growth in Q2, by definition, the Fed is assuming a technical recession in the back half of next year, or this year, excuse me.
So is this the kind of week that you're going to go revise your forecast for when the Fed cuts?
I would say we are not revising anything until the day of the meeting. This is one of the situations where making a strong call is not a great idea because things could change very quickly. Treasury Secretary Yellen can come out with an announcement from FSOC, and we could be talking about something totally different by this afternoon. And so our approach is, take all the information in and make a decision when we have all, good enough handle on things.
But you don't have any cuts penciled in for this year?
No, we have cuts. We have the Fed holding steady until the beginning of next year.